In this free video course, you will learn everything you need to know about moving averages for trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to use moving averages effectively, you will also learn about multiple advanced indicators that most people don't know about. Alright guys, so welcome everyone to this moving average trading course. As always, let's begin here by taking a look at what you can expect to learn from this video. And the very first question we have to answer is, of course, what are moving averages? For example, do you know what SMA 50 mean? Do you know what HMA 20 mean? And so on and so on. We will take a look at some very important things that you need to know before diving into the rest of the course. Next, we're going to talk about how the moving average indicator works. In order to use moving averages effectively, it's of course very important to understand how a moving average actually works. In the next chapter, chapter 3, we're going to talk about moving average as support and resistance. And this right here is a super common trading strategy when it comes to moving averages. But there are many important things you need to know before you start using moving averages as support and resistance. And I will cover them all in a step-by-step manner in this chapter. After this, we're ready to take a look at something called market equilibrium. This right here is a very important concept in trading, and we can actually use moving averages to find market equilibriums, and this is a super important tool to have in your toolbox. In chapter 5, we're going to cover moving average breakouts and moving average crossovers. And these are two more common moving average trading strategies. But they are often actually misunderstood, so make sure to really pay attention to chapter 5. Last but definitely not least, we're going to take a look at the best moving average indicators. I will show you guys some of the best moving average indicators out there. I will compare them, and we're also going to take a look at how you can change the settings to potentially improve these indicators. So now then, let's begin here by taking a look at what are moving averages. A moving average is a statistical calculation that reduces noise and smooths out the price data. So for example, if you take a look at this chart right here, you can see that this blue line on the chart is a moving average. And to be more precise, it's an SMA 50. And we will talk more about that very soon. But for now, what we need to understand is, if you take a look at the price here, you can see that the price moves up and down a lot in a very sort of erratic fashion, while the moving average have a very sort of nice and smooth price movement. And this is what we mean when we say reduces noise and smooths out the price. So instead of having price movements that look something like this, a moving average will be nice and smooth. And what are moving averages used for? Well, moving averages has tons of different use cases. They can be used to, for example, identify trends. Moving averages can also generate buy and sell signals, and also so much more, and we will cover all of that in this course. So now let's dive a little bit deeper into how the moving average actually works. As I already mentioned, in order to use moving averages effectively, we of course need to understand how they work. Every moving average has two classifications. They have both a length and a type. And the length of a moving average refers to the number of periods used to calculate the average. So if you, for example, take a look at this chart right here, you can see that this purple upsloping line is a moving average. And to be more precise, it's an EMA 20. And it is this number right here that refers to the moving average length. So in this case, the moving average is based on 20 periods. But what do I mean here by periods? Well, the period will depend on what type of chart you're using. So for example, on this chart, we're using daily candles, which means that every single candlestick on this chart represents 1 day. So in this particular case, the moving average is based on 20 days. But if this instead was, for example, a 1 hour chart, then the moving average would be based on 20 hours. And if this was a 5-minute chart, the moving average would be based on 20 5-minute candles, and so on and so on. The next classification we need to understand is the type. One of the most common types is the SMA, or in other words, the simple moving average. Another type is the EMA, which is the exponential moving average. And here on our chart example, we had an EMA 20. So this basically means that we have an exponential moving average based on 20 days. So here are some examples of full classifications. We can, for example, have an SMA 20, and that is a 20 period simple moving average. Or we could have a EMA 50. In this case, we're talking about a 50 period exponential moving average, and so on and so on. And now guys, I want to just super quickly take a look at the moving average calculation. And even if you hate math or don't like math, I highly recommend that you don't skip this chapter. First of all, I will keep the chapter super simple and straightforward. And also, in order to, really master moving averages, having a basic understanding of how they are actually calculated can be super useful. The first thing I want to notice is that different moving averages have slightly different calculations. So for example, the simple moving average is not exactly the same as the exponential moving average. The reason why these moving averages are behaving slightly different is because, of course, they are calculated in slightly different ways. But the important thing to learn here is that all moving averages, as you can hear on the name, calculates averages of price movements. And to understand this, let's take a look at a very quick calculation of the simple moving average. So as you guys can see, right here we have the formula for the simple moving average. And you can see that we have A1 plus A2 and so on up to AN. And these fancy letters are super simple. It's simply where a candle closed. And then you can see that we divide all of the closing prices with N. And N just simply means the number of total periods, or in other words, the length of the moving average. So to make this very simple, let's just say that we have a simple moving average with a length of 5. So to calculate this, we need to add up the 5 most recent closing prices. And to make this very simple, let's say that the most recent price was 7. So the price closed at 7, for example, today. And before that, it was 6. Before that, 5. Before that, 4. And before that, 3. So these are the closing prices of the last 5 days. And to get the moving average, we simply divide by the length. And remember, the length here is 5. So we divide here by 5. And this will simply be equal to 5. So in this case, let's say that these sort of lines here are the price. These 5 bars right here are the last 5 bars. In this case, the moving average would be somewhere right here, just in the middle between this point and this point. So now it's time to take a look at one of the most popular moving average trading strategies, and that is the moving average support and resistance strategy. And as you guys can see, here we have a price chart and we also have a moving average. And in this particular example, you can see that it looks like every time the price fell down to this moving average, you can see right here, right here, right here, here. You can see that every time we fell down, it seems that the price bounced. The price wanted to bounce every single time we reached the moving average. And this right here is something super common for beginners. They will look at some charts and then they will find a perfect example where, the price seemed to bounce every single time it reaches a certain moving average. And there are actually a few problems with this. The first problem here is that for every perfect example, like we're seeing right here, you will be able to find tons and tons of examples where this is not true. And using moving averages like strict support and resistance levels is actually often not a good idea because you will get so many false signals. With that said, this can actually still be a useful strategy. But in order for this to work, you need to know about some specific rules you need to follow. The first rule here is that you only want to use moving averages as support and resistance in clearly defined trends. And in this example, you can see that we have a clearly defined trend. You can pretty much see it by just looking at the chart right here. The chart is clearly rising here from the left corner to the upper right corner. But a more precise way to find trends is to identify swing highs and swing lows. So for example, here you can see that we have a swing low, we have a swing high, we have a higher low, we have a higher high, once again a low. Here we saw a minor high and a minor low, but this was just a structure, right? You can see we had a sort of a large pullback, and then the trend continued to push higher. And if you guys want to be able to identify these swing highs and swing lows correctly, I actually have a full 1 hour plus long course on market structure. In that video, I talk about everything you need to know about identifying trends correctly and so much more. So I will make sure to link the video somewhere up in the corner in the eye. And when you have the time, I highly recommend you guys to watch that course. But okay, so the first rule is to only use them in clearly defined trends. The second rule here is that we don't want to rely on moving averages alone. Or in other words, to improve our win rate when we use moving averages together with support and resistance, we want to combine them with other technical variables. For example, chart patterns or candlestick patterns, and as I already mentioned, you can also combine it with market structure principles. And in this particular example, the chart patterns combination was a very good tool. If you look here at the bottom left corner, you can see that the price pushed up right here, and then we sort of saw a minor pullback coming in to the moving average. We can define this pullback using a resistance and a support line like this. When we see an impulse move and then a move against the direction of the trend that goes in a channel like this, this is what we call a bull flag pattern. And a bull flag is a bullish chart pattern indicating continuation to the upside. And by the way, guys, if you want to learn more about chart patterns, I also have a full course on that. So I will make sure to link that video up in the video card as well. But so in this case, we actually had two things happening. First of all, we saw the price coming down here to the moving average. So that is one bullish sign. But at the same time, we also saw a bullish pattern. And if you have been watching my chart patterns course, you know that at this point, when the price breaks the upper resistance, this is a good bullish entry point. And if we actually look closely here, we can see that the same thing is true about this next price movement. So here we had this strong impulsive move towards the upside. Then after this movement, we saw the price consolidating here against the direction of the trend. The price came down here to the moving average. Actually, we dipped just slightly below here. But when we broke the upper resistance line, this sort of bull flag looking pattern is confirmed, and that is a valid entry point. So once again, in this example, we have two bullish variables happening at the same time. We have this supporting moving average that is in a clearly defined trend, and we also have a chart pattern supporting our trade even further. So now the next thing I do want to cover here is something super important, and that is something called market equilibrium. And moving averages can actually be a very useful tool to find market equilibriums. So if you take a look at this chart right here, you can once again see that we have a blue moving average. And we have the price sort of moving up, moving down, moving up and down. And the first thing you can notice here is in this example, when the price is sort of going sideways, you can see that this moving average works very poorly as support and resistance. You can see that it broke it right here, it broke it right here. The moving average failed to hold support and failed to hold resistance pretty much all the time. A beginner looking at this chart might say, you know, for example, didn't you see right here it acted perfectly as resistance, and right here resistance, right here resistance and support, and so on and so on. But these touches right here are more or less random. When you have a moving average going through the chart like right here, you will always see some touches that looks like true support and resistance, and that is simply inevitable. It doesn't mean that it's a good or real support and resistance. But now then, what do I actually mean with market equilibrium? Well, what I mean here is that the buying and selling pressure in the market is pretty much the same. And this will make the price movements in the market more or less random. And when prices are more or less random, it's super hard for us traders to make profits, at least to, be consistently profitable. So my general recommendation here is that when you see a very flat moving average, like we're seeing right here, this is an indication that at least on this time frame, the market is currently pretty random and it's hard to trade. So one simple recommendation, at least for beginners, is that when we have a very flat moving average and the price is just going up and down, especially, in this case, we still had some pretty large and nice movements. But if you imagine the price going pretty much sideways here, and you have the moving average just hovering around the price going super flat, this is usually an environment you want to avoid. And what you definitely don't want to do in these environments is to use the moving average as support and resistance. So now you guys might wonder, should I always avoid markets that are going sideways? Well, there are actually productive ways to trade in sideways markets, especially when we have sort of strong moves, like we, for example, have right here. You can see that even though the price is going sideways, we have some pretty nice swings. And one way to trade these markets is to define the range here. You try to define the trading range, and you try to trade at the moments here where the price is close to the edge. So even though the price here in the middle is highly random, you can still find moments here in the markets when the price is slightly less random, and that's when trading opportunities happen. Alright guys, so now we are finally ready to talk about moving average breakouts. And the first thing we have to understand is, what do we mean when we talk about breakouts from moving averages? Well, let's take a look at this chart right here. This chart right here was actually the stock market crash that happened during COVID. And I think that this is a great example to demonstrate what a true moving average breakout actually is. A moving average breakout is, in very simple terms, when the price clearly crosses below a moving average or clearly crosses above. So these 2 points right here are clear examples of breakouts. While, for example, this point right here, you can see the price quickly dipped below the moving average, but then pushed higher. This is an example of a failed breakout, and we will talk very soon about the exact signs you need to be looking out for in order to find good breakouts. But this right here was an example of a failed breakout. You can also see right here, I hope you can see, this was yet another example of a failed breakout. And also, for example, right here, yet another example of a failed breakout. But now then, in order to find good breakouts, we need to look out for certain signs. And the very first sign we need to look out for is increased momentum. And one simple way to measure momentum is to measure the real body of the candle. So if you, for example, take a look at this candle right here compared to this candle right here, this candle has much more momentum. And when a candle is at least twice as large, but preferably, 3 times as large or 4 times as large as the previous candles, then we usually call the candles momentum candles. So when we see the breakouts here, preferably we want to see momentum candles. And if we take a look at the first example right here, you can see this red candle. You can indeed see that the real body of this candle, so this point to this point, was pretty large compared to the previous candles, maybe twice as large as this one, twice as large as this one, but more importantly, the candle was, maybe 4 times as large as all of these previous candles. So this right here, when we see a strong momentum candle dipping below a moving average or clearly pushing above, that is a first good sign. The next sign we're looking out for when it comes to good breakouts is that we want to see a strong candle close. And what do we mean by this? Well, let's say we have 2 candles. We have one candle that looks like this and has a long lower wick, so something like this. And we have another candle that is the similar length, but in this case, the body here is on the top. And let's imagine that this right here is the moving average. If we're looking out for a breakout here to the downside, which of these candles are most likely to lead to a breakout? Well, in this example, it's pretty obvious. And that is because in one case, we see the candle closing far below the moving average. While in the other example, even though the price went down all the way down here, we can see that the candle actually closed above. But even if we have an example, let's say that the other candle looked something more like this. And once again, we have the moving average going like this, just as we saw right here. Which of these candles is the best breakout? Well, once again, we can see that one of the candles has a stronger candle close, meaning that the candle closes further below the moving average compared to this candle. So this candle is more likely to lead to a breakout compared to this candle. And this is exactly what we mean when we talk about strong candle closes. We want the candle to close either far below or high above the moving average. The next sign we're looking out for here is increased volume. And in this example, we don't have a volume indicator currently on the chart. By the way, if you want to learn more about volume, I highly recommend that you watch our price action trading course here on the channel. I will make sure to link the video up in the video card. But what I mean with volume here, let's say we have two examples. We have two candles that is exactly the same. The candles looks exactly the same. And once again, we have the moving average coming in right here. However, in the example to the left, we only have a small volume bar, while in the example to the right here, we have lots of volume. Volume basically measures, how many stocks or how many cryptocurrencies or forex or whatever that was traded during a specific time period. And a sort of simple way to think about this is how many buyers or sellers are agreeing that this is a valid move. So if we have a strong volume bar, this will make the breakout more significant because more sellers and more buyers are agreeing that this is a valid breakout. And the last sign we're looking out for when it comes to breakouts is some type of price action confirmation. And what I mean by this, let's once again say that this blue line is our moving average. And we see a pretty nice breakout here with a strong candle close and a momentum candle. What some traders do here in order to confirm the breakout, they will wait for yet another candle to close below the moving average before they enter their trade. And this is what I mean by price action confirmation. And to make the breakouts even stronger, you can also, of course, combine the signs of a good breakout with other, tools such as chart patterns, market structure, and so on and so on. If we take a look at this market structure right here, you can see we have a low, high, low, high. Some traders, before they enter here, might, for example, wait for this low right here to be broken before they actually take the trade. Because when this low is broken, we are no longer in an uptrend. So some traders might wait for this break right here. Another strategy is to actually wait for the retest. So in this case, you can see that the price came down, right? We came up and tested this exact level that was previous support as resistance. So there are many different ways to navigate breakouts, but these rules are always good to have in mind. Alright, so now let's talk about the terrifying moving average death cross. And what I'm gonna say here might be a bit controversial, so make sure to, if you don't agree with me here, you can drop a comment down below. But now let's take a look at the death cross here. First of all, as you can see, we are still looking at the exact same chart. We're looking at the COVID crash. And I'm going to use this example to demonstrate a point. But before I do that, we of course have to talk about what do we mean by a moving average death cross. Well, a moving average death cross is when we have a short period moving average like the EMA 50, and at the same time on the chart we have a long period moving average like, for example, the EMA 200. Using 50 and 200 are the most common values here for the death cross, but you don't have to use the EMA. Some traders use the SMA for the death cross. So let's say that this line right here is our exponential moving average with 200 period, and this line right here is our EMA 50. The death cross happens when the shorter period moving average crosses below the longer period moving average. And this right here should be a bearish signal. But unfortunately, at least for me personally, I am not a big fan of these signals. The first reason is because these signals tend to be very delayed. And if you take a look at this example, you can see that the death cross did not happen until all the way down there. So even if the price continued to go down a bit after this point, you can see that we missed pretty much the whole move. And the other reason why I don't really like the death cross is because they will provide many false signals. For example, in this case, you can see that the cross happened right here. And as I said, this is a bearish signal. But after this point, what happened? Well, this was actually the moment where the price started to just push higher and higher and higher in a very clear uptrend. And if you guys want to, go to TradingView and open up a chart and add an EMA 50 and EMA 200. As you will notice, you will find some signals that works very good, but you will also find tons of false signals. And in my personal opinion, this signal is not that useful, and it's something I'm, personally at least avoiding. But what about the moving average golden cross? Perhaps this strategy is much better. Well, let's take a look here. So first of all, what is a golden cross? Well, once again, to find a golden cross, we need to add 2 moving averages to the chart. We need to have one sort of fast moving average. The most common value here is 50. And we need to have one slow moving average. And the most common value here is 200, but you can use other values as well. You also don't have to use the EMA. Some people use the SMA. And we also have other moving averages like the HMA and AMA that we will talk about later on in this video. These moving averages are actually super useful, and I will talk all about that. But for now, let's focus on the golden cross. So let's say that this right here is our slow moving average, and this right here is our fast moving average. The golden cross is simply the opposite of the death cross. It's when the fast moving average crosses above the slow moving average from below. So as you can see right here, we had an example of a golden cross. And this example looks a little bit better, right? You can see that it looks like the price went up here after the golden cross, right? Well, if we study this one a bit further, we need to take a look at where exactly did the golden cross appear. So it appeared at this candle. I think it was this candle right here, right? You can see that in this case, the price pushed a tiny bit higher, but very soon the price completely collapsed here. And after this, it looks like the moving average sort of entered a sideways movement, or in other words, as you know from earlier in the course, an equilibrium zone. So once again, this right here wasn't really a good signal. And another thing I want to point out, if you take a look at this point right here, what is this? Well, this is a death cross. And once again, we can see that where did the death cross happen? Well, it happened on this red candle right here. And funnily enough, you can see that this was very close to the low. After this moment, the price reversed here to the upside. So here you can see 2 more sort of random examples of this not working. We can actually take a look at the chart once again. Here we have another cross, right? Oh, I'm sorry, I have to move me a bit here so you can see. But once again, once the cross was confirmed, it was already too late, and the price actually moved up after the death cross. So now guys, it's time for a chapter that I think you will really like. In this chapter, we're going to take a look at the best moving average indicators. And so far in this video, we have mostly been talking about the SMA, or the simple moving average, and the EMA, or the exponential moving average. But we actually have tons of more indicators that you need to know about. But actually, the first indicator we are going to talk about here is the simple moving average, or the SMA. And even though the simple moving average, as you can hear on the name, is simple, it's actually a great moving average, and it's critical to learn about. Not only to use the simple moving average to actually trade, but the simple moving average is also a moving average that is found in many other indicators. So definitely guys, don't skip that chapter. Next, we are also gonna take a look at the EMA, or the exponential moving average. This is one of the most common and one of the most popular moving averages, and this is for a good reason. So far, I have been showing many examples of where we use the exponential moving average, but I haven't talked about how the exponential moving average actually works. Next, we're gonna start talking about some more sort of exotic moving averages. The first one we're gonna talk about is something called the Hull moving average, or for short, HMA. This one is amazing and you will soon understand why. But another moving average we also of course have to talk about is the AMA, which stands for Adaptive Moving Average. Last but not least, and this might surprise you guys, we're gonna talk about something called moving average, convergence, divergence. And you're probably familiar, or if you have been trading for a while, you're probably familiar with this indicator. This is the MACD. If you didn't know, the MACD, as you can actually hear on the name, is actually a combination of moving averages. You combine moving averages to get momentum signals. So I'm going to talk a little bit about how this works and go a little bit deeper into how moving averages affect the MACD. Alright guys, so now we're ready to take a look at the most iconic moving average, the simple moving average. And if you think this chart right here looks familiar, it definitely is. This is the example we have been using a lot in this video. So why not continue using this example? And by the way, guys, right now we are in TradingView. This is an amazing sort of trading platform suitable for everything from complete beginners to more advanced traders. And if you want to get started with TradingView, I will make sure to leave a link both in the description and the pinned comment that you can use to sign up for free. And if you want to, you can also do a TradingView premium trial for 30 days. And also if you use the link and then later on decide that you want to upgrade to, for example, a premium or even an essential plan, you will actually get a $15 bonus. So make sure, guys, to use the link down below if you haven't, started with TradingView yet. But now, how do we open up the simple moving average? What we want to do here is that we want to go up here to the indicators tab in TradingView. And here, in order to find the moving averages, you don't want to search for simple moving average. You will be able to find it. But the best way to search here is to first search for moving average and then simple. So I don't know why it is in this order, but the simple moving average is called moving average simple. So feel free to start this one. And now let's open this one up. So now the moving average has appeared here on the chart. And the first thing you can notice here is that when you first open up the moving average, you can see that the moving average doesn't look very useful. It's pretty much hugging the price here very tightly. And that is because when you open up the moving average, the standard setting here is an SMA 9. And as you guys know, this means that the simple moving average is based on 9 days. So now the first thing we have to take a look at is how do we change the length of the moving average. To do this, we want to navigate up here to the upper left corner and we want to press on the settings tab right here. Then you want to make sure that you navigate here to the inputs tab for the moving average. And you can see that the first setting here is the length. So this is how long do we want the moving average to be. So for example, if we change the length to 20, now we have an SMA 20 on the chart. If we want to change the length to 50 and have an SMA 50, we simply choose 50 here and we will have a 50-day moving average and so on and so on. But for now, let's keep this one at 20 right here. And let's actually go up to the settings tab once again. Here on source, we have a few different settings. The close here basically means that the moving average bases its calculations on the closing prices, but you can change this setting. For example, the OHLC4 here will make it so that the moving average bases its calculations on the open, high, low, and close of the candle. This is a pretty common setting, but the most common one, especially for moving averages, is actually to use the closing prices here. And what I also like to do here is to go to the style tab because the normal line is so sort of tiny. So I like to increase the thickness a bit here. I can actually increase it by a lot in this case, so you guys clearly can see. So now we have a 20-day moving average here on the chart. But let's say that we want to have another moving average. One way to open up another one is to simply open up another moving average. And now, because we have this one starred, you can see that this one will come up right away. But if we unstar this one, we can simply search for moving average simple once again and open up another one. So now we have two moving averages, and if you want to change the settings of the second moving average, it's the same process. Let's say we want a 100-day moving average. We choose 100 right here. Let's say we want to change the style and color here. We can, for example, change this one to orange, and we can also make the lines a little bit thicker here. So right now on the chart, we have a 20 SMA right here, and we have a 100 SMA right here. As you can see up here in the left corner, you can see that it says SMA 20 close and SMA 100 close. But now guys, let's take a look at our second moving average, and that is the exponential moving average. So the first thing I want to do here is that I want to remove the simple moving averages on the chart. To do this, we simply go up here to the upper left corner, and we want to press the remove button right here and remove button right here. Then we navigate up here to the indicators tab, and remember, you want to search for, first of all, you want to type moving average, and then you want to type the type, so exponential. So here we have the moving average exponential, or EMA. So let's open this one up. And once again, to the normal EMA here will be based on 9 days, which you can see here up in the corner. And to change the settings, we do the same thing. We go up here to the settings tab, go to inputs here, and let's, for example, choose 20 for this example. And I also just want to make this one a bit more clearer so you guys can see. Okay, so now we have an EMA 20 here on the chart. And in order to understand how the EMA works, I think the best way to demonstrate this is to compare it with the simple moving average. So let's go up here to the indicators tab once again, search for moving average simple. And to make a good comparison here, we go up, let me remove that arrow. We go up here to where it says SMA 9. We want to change this one so we have the exact same length on both the SMA and the EMA. And we also want to change colors, so you can see. Let's change it to orange and a thick line like this. So now the orange line is the simple moving average, and the blue line is the exponential moving average. And the most important difference between these moving averages is that the exponential moving average will react faster to price movements, or in other words, it will give more weight to recent price action. So for example, as you can see right here, when the crash started, you can see that the exponential moving average, or the blue line, started to fall faster compared to the simple moving average, or the orange line. So even though the exponential and simple moving average have the same length, the exponential will react faster. And the same thing is also true during the reversal. So as you can see right here, the exponential moving average reacted faster to the movement towards the upside. It started earlier compared to the simple moving average. And this right here is a reason why many traders prefer the exponential moving average. Especially traders that focuses more on short-term movements can benefit from the faster reactions of the EMA. Okay, so now the time has come to take a look at the HMA. And the HMA is a newer moving average. It was developed by a guy called Alan Hull, and that's why it's called the Hull moving average. And this moving average actually has two goals. It wants to both improve the responsiveness of the moving average, while at the same time improve the smoothness of the moving average. And the calculations for the HMA is much more complicated than both the SMA and EMA. But this right here is not something you have to worry about. Now, let's take a look at how we open up the HMA in TradingView. Once again, we go up here to the indicators tab. And for some reason, for this indicator, you want to first search for Hull here. And that is actually enough. If you search for Hull, you should see the Hull moving average coming in here at the top. So let's open this one up. And once again here, you can see that the standard settings for this moving average looks pretty useless. You can see that the line is sort of hugging the price right here. So it's definitely recommended to use a longer period. You can see that the standard period here is 9. And for this case, to demonstrate, let me actually increase the length all the way up to 50 here. And as for the style, we can increase the thickness a bit here so you can see it much more clearly. And now, as you can see, we have a very sort of smooth and very responsive moving average here on the chart. In order to show you guys how responsive this moving average is, let me actually open up both an EMA, so moving average exponential. Let me also open up a moving average simple. And we want to make sure, of course, to make, you know, the length 50 of both of these. We can make the EMA to orange, and we can make the SMA another color. Let me make this, for example, purple. And let's increase the thickness once again. So now we have three moving averages here on the chart. We have the purple line, which is the SMA. We have the orange line, which is the EMA. And we have the blue line, which is the HMA. And what I want you guys to notice here is, first of all, how big of a difference the sort of responsiveness is between these moving averages. So for example, the Hull moving average reacted to the crash all the way up here. So pretty much when the crash started. The EMA took a little bit longer time. You can see it reacted down here, while the SMA took the longest time to react. So the HMA is much more responsive compared to the EMA and the SMA. But interestingly enough, you can also see that the HMA has a more sort of smooth movement. You can, for example, see that the EMA goes a little bit up and down, and you can also see that the SMA goes a little bit up and down, while the HMA prints a very smooth line. So what are the pros and cons of the HMA? Well, one thing that can of course be a benefit is the improved responsiveness. So if you are a short-term trader that needs to make quick decisions based on, you know, the most recent price movements, the HMA can be a great choice. But one downside with the HMA is that because it reacts so quickly, you will see that we will actually get many false signals. You can, for example, right here, the price broke below the HMA, right? But then it quickly pushed above. You can also see that many times during the uptrend here, the price actually broke below the HMA. So the improved responsiveness can both be a sort of good thing if you are a very fast-paced trader, but it can also be a negative thing as well. And remember from earlier in the course, what I always recommend here is that when you trade based on moving averages, you want to, in order to take better trades, you want to combine it with other technical analysis techniques like market structure. I highly recommend learning about market structure. I highly also recommend learning about price action. All right, so the next indicator we're going to cover is the LAMA, or simply ALMA. The ALMA indicator, I would say, is more similar to the HMA compared to, for example, the simple moving average or the exponential moving average, but it uses a different approach and it also has some different settings. So to show you guys the ALMA, the first thing I want to do here is that I want to cross out the SMA and I want to cross out the EMA. But I actually want to keep the Hull moving average so we can compare it with the ALMA. And now we are ready to open up the indicators. So we go up here once again to the indicators tab. And now I think you want to search for ALMA, like right here. And the indicator you want to open is this one right here. I will not even try to pronounce this, but it's Arnaud, Legoux, blah, 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 moving average. And you want to open this one up. And as you can see, now the indicator has appeared here on the chart. And as always, it's not very useful with the standard settings. So we right away want to change the settings here. And here on the settings tab, you can see that the settings look very different compared to, for example, the SMA or even the HMA. Because here we have actually three different setting type. And the first setting where it says window size, this is actually pretty much the same thing as length. And because we use the HMA 50, we want to make sure to change the length here or the window size to 50 here. But as you guys can see, we also have a setting called offset and we have a setting called sigma. And the reason for this is that ALMA uses a different type of calculation called Gaussian distribution. You definitely don't have to learn Gaussian distribution, but it is quite important to know that it uses a different method. And changing the offset and the sigma values here will affect both the smoothness and responsiveness in slightly different ways. But for this video, to keep it simple, let's actually keep the offset here at 0.85 and let's keep the sigma here at 6. The standard settings are there for a reason and they are pretty solid. Next, we want to go here quickly to the style tab so we can make a comparison. I'm going to make this one orange and a bit larger. And now we're ready to go down here and press OK. So now the blue line here on the chart is the HMA and the orange line here is the ALMA. And the first thing we can notice is that just as for the HMA, the ALMA is, very smooth. And what we also can notice is that with these settings, you can see the HMA reacts a little bit faster than the ALMA. You can see right here, it's a tiny different. But here at the bottom, you can also see that we have quite some difference, both on the time scale, but also on the vertical axis as well. So now you guys might think, isn't the HMA a better moving average because it reacts faster? For example, it predicted the crash here earlier compared to the other moving average. And it also predicted the reversal here earlier compared to the ALMA. And while this is true, remember from earlier in the video that this can be both a good and a bad thing. As we talked about earlier, you can see that for the HMA, the price actually during the uptrend here dipped below multiple times. While for the ALMA indicator, we can actually see that the price stayed above the moving average. And also before the COVID crash, you can see that the ALMA moving average acted as better support. So here we have a trade-off. Do we want a more responsive moving average while at the same time getting, many false signals? Or do we want a less responsive moving average that respects the trends better? And here the answer to this question will depend on a few things. Such as, what are you trading? Are you trading, for example, a very volatile altcoin? Or are you trading, more stable stock or forex pair? And it also, of course, depends on what is your overall trading strategy. If you, for example, focus on breakout trades, the ALMA indicator might be a bit better. And why is this the case? Well, as we talked about, the HMA would see many false breakouts. But if you're using moving averages only to identify trends, perhaps using the slope of the HMA will perform better. So now, last but definitely not least, let's take a look at the moving average, convergence, divergence, or for short, the MACD. First of all, let's open up the MACD indicator, and to do this, we once again head up to the indicators tab and we simply search for MACD right here, and you want to open up the indicator called moving average, convergence, divergence. And now the indicator should appear here at the bottom of the chart. And let's actually begin here by making the MACD to a full screen. And to make you guys see the MACD a bit more clearly, I'm gonna change the thickness of the MACD line and the signal line like this, and now we're ready to press OK. Alright, so first of all, the MACD indicator consists of two lines. We have the blue line right here, which is the MACD line, and we have the orange line right here, which is called the signal line. And now you may of course wonder, how are these lines related to moving averages? Well, the MACD line is actually equal to a 12 period exponential moving average minus a 26 period exponential moving average. While the signal line is a 9 period exponential moving average of the MACD line itself. So this orange line right here is basically an average of the blue line. And because of this reason, when the blue line crosses the orange line, the slope of the orange line will shift. As you can see once again here, when the MACD line crosses the orange line, the slope of the orange line once again shifts to the upside. And what you also can see here is that we have sort of peaks and valleys of the MACD indicator. What is the meaning of these peaks and valleys? Well, these peaks and valleys basically measures the distance between the orange line and the blue line. So as you can see, when the blue line is above the orange line, like right here, we will have a peak. And as long as the blue line is below the orange line, we will have a valley, like right here and right here. And it is the distance here between the blue line and the orange line which will determine how deep the valleys are or how high the peaks are. And you can use these peaks and valleys as a measurement of momentum. You can, for example, see that when the COVID crash started here, the MACD saw strong bearish momentum, and when the price started to reverse here, we saw strong bullish momentum. But this right here is a way too simplistic way to use the MACD. And unfortunately, I think the MACD indicator needs a whole video on its own because it's a very useful indicator, and I could probably spend, 30 minutes or an hour just talking about the MACD. So yeah, guys, if you're interested in seeing a full MACD video in the future, let me know that down in the comments below. But before we wrap up here, I also want to show you guys the settings real quick here for a MACD. So we go down to the settings tab and we go here to inputs. And as you can see, if you want to, you can change the settings of the MACD. We can change how the MACD line is calculated. Remember, we have a short period moving average, which is the fast length. We have a slow length moving average, which is the slow length. And you can also change the length of the signal smoothing as well. And you can change here the type of moving average. So the standard type here is the SMA, but you can change it if you want to an SMA. And in theory, you could use an HMA or even an ALMA indicator as well. Alright guys, so this course is coming to an end very, very soon. But before we wrap up, I want to thank you all so much for watching. If you guys did find value in this course, the best way to support my work is to simply drop a like on the video. I'm super, super thankful for every single like, and they help out more than you think. And also guys, of course, if you have any questions or feedback, please don't hesitate to leave a comment down below. I try my very, very best to answer every single comment. And also guys, after watching this video, you definitely deserve a break, but it's important that you don't stop learning. So when you have the time, I highly, highly recommend that you check out this playlist right here. In this playlist, you can find all the trading courses I have made here on YouTube so far, and there are tons of more videos coming very, very soon. So yeah guys, I really hope to see you in another video very, very soon, but for now, take care, ciao, ciao.